Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Welcome back to the Wade Borth podcast. Thank you so much for everybody that has walked through this series with us today. Again, my friend David Zapata from Factum Financial is joining us to run through the conclusion of what we call our tough money conversation or tough money curriculum, which is just really about how do we grow a relationship with our money. And we do that through awareness, through being purposeful, and really just aligning our values with our actions, with our dollars. And it's an exercise. It's not a dictate, this is what you need to do. It's about bringing awareness along with some education and really a guide to say, okay, if you want to know more, because again, in a podcast, it's difficult to show all the ins and outs of this. There's so much more to it. We've actually had it as a 2-day curriculum. It can be that deep, right? Where we can get that deep into the conversation. So today we're just going to snorkel through this conversation with David. Touch on what I mean by snorkel is that we stay on the surface, maybe go down 10, 12 feet, but there's 100 foot of opportunity here for us to go into if you want to go deep into these conversations. And I would encourage you to hear this, see how this works in your life, right? See how impactful this can be in your life and say, I need to know more. I need to get in contact with Wade. I need to get in contact with David. We work together in all these conversations with our clients. And it is a great partnership that I bring David on the podcast. He's a great friend of mine. He's a great colleague. And quite frankly, a great partner in all our conversations. David, I've appreciated this conversation on tough money because it isn't a playbook to say this is what you need to do. It is more of a workbook to say, do you understand and do you see opportunities where you can bring that alignment to your actions and your values with your dollars. And so, Again, thank you so much, David. I'd appreciate really your work and effort of bringing this to people. I know you're out teaching this to people all over the country, and just people should know that this is an opportunity for us to work with David as well. So I would let you kind of maybe wrap things up as we move into the last part of this, the part 4 of the conversation.
Wade, thank you for having me and the kind words. I'm grateful for our partnership and our work together. I'll tell you something you said there that is so important. Like the objective, as I stated in one of the episodes, was we all need to get closer with our money. If we talk about the relationships we have in our life, we talk about this in the 5 areas of life: personal, spiritual, with our family, with our money, with our occupation. Their relationship is that contact, is that conversation we have with these things. And money has this interesting role in our life that a lot of times we are okay hiring a third party to manage it for us when we need to actually have a relationship with that entity, the money. It is very hard, again, I say this all the time, to send my kids to Europe for 18 years of school and expect that we're going to have a close relationship at the end of it. But we do this with money for 30 years most of the time. And the objective being that we all develop a closer relationship with money, because that's what brings financial health to our families, to our households, to our businesses, to our communities, eventually to our country. Okay. So this last part that we're going to talk about here is now that we've worked through the balance sheet and we've separated liquid assets at the top, the security portion of your balance sheet with your investments. The part that we also need, by the way, we're not suggesting by any means that you should live a life where all you have is liquidity and nothing else, because that makes no sense. You need to have a portion of your money also be in the investment side of the world, because we need to create growth. We need to build wealth. And investments, when investing, when controlling risk, when knowing what we're doing, have the purpose of creating additional money, creating cash flow, we call that, to continue to grow our wealth. And that is a very important role in the whole conversation. Now, a full disclosure up front is we are a business and we are professionals dedicated to the foundational piece of the conversation. We'll talk about protecting you. We'll talk about retaining and keeping more of the money you earn. We're not necessarily a firm that is going to tell you about investment vehicles or investment strategies. We do not endorse any particular investing strategy whatsoever. So this conversation is an awareness and financial education conversation about the interaction between your liquid assets and your investments, and perhaps developing a more intentional framework about investing itself, less about any particular security or piece of real estate.
So I'm just going to reframe kind of what you said because I think it's so important. We're not going to sit here and say this is where you need to invest. What we want to do is
Nope.
bring awareness and help you, empower you, really, When this is where we see our values, empower you to build that framework. Does this fit within my set of values and what I really want to achieve? Does it fit my goals? Does it meet my goals, my objectives, my vision, and is aligned with my values? Because I've heard Kyle say this many times. We're not going to talk about investments because that's not what we do. But investments, which again, we're going to have a discussion about the difference between investments and speculation. But investments are as unique to every person that's listening to this, and nobody's the same. So we're not going to say that one is better than the other. That's just not where we live. We want to live in the world of certainty versus we want to live in the I know world versus the I think world. And the I know
Yes.
world lives, like you said, at the foundation of, hey, what's your strategy for storing liquidity, and what are those things that you want to store your liquidity? And again, anybody that knows me or my podcast, a good portion of where I store that is in my whole life policies, because it brings me that long term certainty that I'm looking for. Short term, it's a different conversation. Investments, completely different conversation, because again, I've done some of those things, but what's right for me isn't right for everybody else. And from that standpoint, we're not gonna tell you what to do. We're just gonna help you bring some awareness to maybe think of a structure so you can evaluate those assets that you're looking at. Is that fair to say?
I think so. I think that, again, seems trivial, but is an important way to orient the conversation about what are we after here. And I think it's about proper classification, understanding how to audit our financial statements, and understanding the relationships between these things that you just mentioned. So let's get into the conversation. I think the starting point of the Tough Money Workbook, after we talk about our liquidity strategy, is to now get into the investing world. And as always, we don't drift to a desired location. So, what if we start with the end in mind and we set some targets?
Yeah.
And I think one of the important recognitions we must have in this part of the conversation is that there are multiple ways to arrive at a destination. A lot of Americans, for example, if you go and look at the average composition of an all-American family, will have a lot of assets in a world where they want to accumulate value, and then they plan to distribute over time at retirement age or passive income age. That's one strategy, no wrong or right. You may be engaged in portion of that. Other people prioritize the idea of, hey, what if I can create income now so I can replace through my income and through my assets my ability and my need for future dollars to finance my lifestyle. That's a cash flow strategy. How do I buy things that pay me to own them so I can have income in perpetuity moving forward? Again, no right or wrong, just different ways to look at it. And if we follow that trend, one of the interesting things is to have a conversation about what we call freedom numbers, passive income targets. What if we could set an investment strategy that is focused on creating or acquiring assets that pay us to own them, a monthly amount that replace our need for active income, or add, in addition to our active income, a certain amount of monthly income that accounts for our daily burn rate or accounts for our monthly expenses and sets us free, allows us to buy our time back.
Yeah.
And we call that number our minimum freedom number. If a family has $10,000 in monthly expenses, $10,000 and $1 above that, it's our minimum freedom number. And the problem becomes about how do I buy enough assets that at the end of the month, all the assets I own pay me $10,001 so I can have that minimum freedom number or passive income target. Very simple conversation, but the conversation here takes a different focus. It's definitely not an accumulation discussion. It's a conversation about how do I get myself to that freedom point as soon as possible so I can then use my life in a way where I add more value or I grow, blah, blah, blah. And we set that as a financial freedom standard. One of the things we do here that is really important is to bring back the 5 areas conversation. And we ask people, imagine how your life, how your relationship in your 5 areas of life would feel like if you had this level of passive income coming to you every month. And it's fascinating to hear the feedback and the conversations from clients about how important would that be, would to be to achieve that for them to be at a 8, 9, 10 with respect to their relationship with their spiritual life or their family or their occupation. And for those that have already arrived there, man, the perspective they have about that being just the beginning is so healthy, because then we progress the conversation to what we call the infinite freedom number, which is now that you get to that minimum standard, what if you actually create a multiple of that, 2 times, 5 times, 10 times, 20 times? Let's say if your monthly expenses are $10,000, what would your life look like if your monthly passive income was actually $100,000?
Yeah.
How do we get to think from that level of freedom? What would you do? How would you spend? How would you contribute? How would you add value? What profession you would choose? All these conversations are really important to be able to set a target in the future that allows you to operate with clarity about where you're going.
There's some real power there in that conversation, because if people can't imagine something, how are we expected to even strive for it if we haven't even taken the moment to say, what does that look like and why am I doing what I'm doing? And so we get the why we do what we do in order to align with that, again, that imagination. It's like,
Yeah,
that's the life I want to lead right there. Okay. And once your brain and once your subconscious accepts that, it's an amazing thing. Is like our conscious will find a way to make that happen, right? That's
yeah,
always interesting how people that, and again, there's a lot more between there. It's not just that simple, but there's a lot between it. If we, again, like you said, you don't drift to a desired location. I tell the story all the time of, if I want to go hop in the boat with my son and go to my favorite fishing hole, I just don't put the boat down off the lift and let it sit there and float. I got to put the motor in the water, you got to turn it on, and we have to drive to that location. But we know where we're headed, right? It might take us some time, takes us a little bit of gas, a little bit of energy to get there, but eventually we'll get to that desired location. And this is all about, what do we have to do to turn the key on? What's our framework? What kind of boat we're in? All those little details that will allow us to get there. But first, we have to start with, where do we want to head?
yeah. You want to make this very real to you for those listeners that are hearing this conversation is still not connecting or not doesn't seem as significant. Let me give you an experiment. Okay, this is a mental exercise. The All-American family's balance sheet, 75% of it is allocated to three types of assets: equity in their primary residence, equity in their retirement homes, or a brokerage account with stocks and securities of different natures. Okay. And one of the exercises I ask people to think about this, starting with the end in mind, is this. Ask yourself, forget about anybody else. Ask yourself, if you own a retirement account, if you own a retirement plan, if you're focused on storing as part of your investment strategy equity in your home, ask yourself what the current details are for the distribution stage of that plan. What is distribution of the assets from a retirement account look like 10, 20, 30 years from now? Ask yourself that. I ask this question 20 times a week, Wade. And 19 times a week, I hear silence. I hear silence. Most Americans are engaged in a paradigm of accumulation and distribution where the conversation, 90% of it is about the accumulation part of the plan, how much I need to be put in and what assets, and they know it all. Nobody's having a conversation about what distributions would look like because it's full of uncertainty. And most Americans would have a radical shift in their financial plan when it comes to an investing strategy if they started to talk about, hey, what is the end goal in mind? What does this look like in terms of how it impacts my real life today and in the future?
Right.
That experiment has been very powerful just to open our minds to thinking perhaps there's a different way to be acting on regards to my investing strategy from a goal in mind. So I'll leave it there, but let's move the conversation forward. So we talk about these freedom numbers, fascinating conversation, and now we're going to do a little bit of education here when we get to that investing strategy. And the first thing we tell people is we're not going to recommend you any investing strategies or vehicles. What we want is to give you a framework to think about this. How are you thinking about when you invest, how much you invest, and why you invest? Questions we ask people. And then we give them a framework to think about, hey, what about the different durations that you plan to own assets? Short term, less than a year, midterm, and forever assets. This will clarify what role some of those assets play in your life. And we will ask them about the relationship between the expectations for returns, for risk, and for noise. Owning two assets that both yield the same yield, let's say 10%, are not the same thing because they may have inherent different risk levels and they may be very noisy or not, depending on what you own. For example, if you are in the space of real estate, owning an Airbnb and owning a single family residence and long-term lease may have the same return, but they do not have the same levels of risk, and they certainly do not have the same level of noise. And you have to identify which one may be right for your situation, your values, your knowledge, the size of your team, etc.
Yeah. Even if you take that, because that's a great example, because I don't think my conversations with a lot of people, they don't give the duration a whole lot of even right. Just
Yeah.
like we buy something, and then what's the plan to sell it or move it or change it out? And maybe there is a plan, but rarely do I ever hear that there's a plan, right? But to the point of your example of buying an Airbnb versus just a single family resident for long term lease, right? Even if there's a difference in return, because obviously there would be. The question is, are all those other things worth that higher rate of return? Because again, if all we see is, oh, this one's going to get me over a 30-year period, it's going to give me 8 or 10%. That one's going to give me a 20%. They see 20 being better than 10. That's partially true, but it's not the whole story. It's what's it going to cost you to get to that extra 20, right? Is it going to cost you a lot of, I can't get my own job done because I'm spending way too much time on my Airbnb, or that's what I want to focus on. So that part of the conversation, really that exercise you do in the Tough Money workbook and the seminar that you put on is so important because people, even seasoned investors, have not given that much thought.
Yeah. And again, it's not a one-time exercise. It's a constant reevaluation of what is happening in our balance sheet. This is a habit, not a one-time exercise. This is so significant, relevant that we need to. We do this piece of education, and now we're immediately going to go into awareness and implementation. This is not about you sitting down and listening to someone blabber for a day and a half. This is about you having a conversation with yourself with a piece of paper in front of you that is meaningful and significant for your financial life. The exercise they're going to go after going into that investing criteria we share with them is going to be to literally replicate their balance sheet in front of them. We're going to go identify the assets we own and we're going to put them into the short term, midterm, and forever buckets. This is relevant because if you own, I'm going to give you a simple example we've heard in rooms. If you own an apartment complex and you don't understand that's a forever asset you want to use for multi-generational wealth transfer and tax benefits or whatever it is that you're using it for, you may sell that at a time that you don't want to sell it because you didn't have that properly classified in your mind. You may have a short-term asset that you keep way too long because you didn't understand that it had a short-term purpose in your balance sheet. So this classification is really important for clarity on decision making. And then you're going to identify three aspects for every line item you put in that balance sheet weight. You're going to get clear about the net equity in the investment, meaning how much is the asset worth minus any liabilities or debt associated to it. If you put your primary residence, for example, if the house is worth $500,000 and you have a loan for $400,000, you have $100,000 of net equity invested in that property. You're going to do the same for your retirement accounts, for any bonds, for any stocks, mutual funds, anything you own, if you own real estate, if you have loans, if you have businesses, and you're going to get clear about all of that. And then you're going to identify, hey, what are my actual rates of return in these investments? And what cash flow am I receiving on a monthly basis to own this asset? And what comes out of the exercise is people get surprised because when you start looking at net equity, which is the number that actually matters, you'll get very clear about how much actual investment do you own out of all these assets. You'll go closer to a net worth identification. And you'll also be able to see what's working more effectively on others. The rates of return you have in a primary residence are not the same that you have in maybe a brokerage account or an investment loan or anything like that. And a lot of these assets, a lot of people have a lot of investment equity accumulated in assets that pay no cash flow to own them. So it's not affecting their daily life from an income perspective. This piece of the exercise, again, very helpful. And we go to rooms where people are very sophisticated. They own 100, 200, 500 doors, right? Multiple properties. And they go and do deep evaluations about their portfolio. What are the actual rates of return? What is the cash flow? And they see the opportunity to either reallocate some of those investments to investments that are working better from a cash flow or a rate of return perspective, or they need to move some of that into a liquid position like Mr. Buffett is doing currently to be able to balance their portfolio weight.
Yeah. I think that's a great point. Is that if we let one of the two, right, liquidity versus or wealth accumulation tools. If and again, the visual that you use, I love, is a pyramid. As the top grows, so goes the base and the bottom. They both have to grow proportionately. And again, are they always the same all the way through life? Absolutely not. But they have to have proportion to them. And I think that's really where Warren Buffett is. He's moving to a stronger cash position. I need to have that foundation base because maybe he sees an event coming or whatever the case might be. And then when times change, that allocation changes. So it's not like this is a static number. It needs to be changing. It needs to be flexible as the environment changes, as what goes around us changes as well. I've seen you do that. And I've seen people in the room like, oh, it's not, because most people are so used to it's this or that versus,
Yes.
oh, we need to be fluid here. And the fluidity is the real key. Is like in certain times of my life, I can be like super heavy on the investment side, maybe a little less liquidity, maybe because they took advantage of '08 or 2001, 2002. They took advantage of a down market, whatever it might be. So maybe that changes. But as life goes on, they move more back to a balanced portfolio, maybe even a heavier on the liquidity side. So it's that balance and that continuation of the rebalancing. And it's the thought process that goes behind it that's the value. It's not the actual what's the number, right? I think there's some real sound advice there that they can get from this conversation that you're having with the tough money, because that's ultimately the application of where this is headed. Do we have the ability to move that pyramid? Do we have a bit wider base? Do we have more up in the top? But do we have the ability to move along there? And if we have everything stuck into one asset and we don't have that ability, then eventually that's going to crack that pyramid, as it were, because we don't have the ability to move when time changes.
Yes, and that's the perfect segue to the last two conversations of the workbook. One being to round up your investing strategy. Remember, it's not just a conversation about rates of return or cash flow. We need to include in that our preference for risk and our preference for noise. And the beauty of the exercise is that you can take those decisions you make about how much you want to think of risk and noise and communicate that to your team. So your tax professional, your estate planning, your investment advisors can help you align those preferences with the assets you're putting in your balance sheet. We have a whole conversation we do about risk. It's a fascinating topic. I don't think most people talk about risk properly. There's a gentleman, his name is Howard Marks, who has this free memo. He's the co-chair of Oak Tree Capital, $200 billion in assets, very famous guy in Wall Street. And he's been putting this memos where he talks about risk in a way that's very nuanced. He says most academics equate risk to volatility, and that's not what risk is. Risk cannot be quantified before or even after an investment. He has this experiment he talks about, Wade, I think worth mentioning here is if you have an investment that you buy for $1 and a year later you sell it for two, okay? What risk did you take? And the point he makes with that simple question, which is really interesting, is that rates of return say nothing about the risk you take in an investment.
Yeah.
It's fascinating to think about that. And risk needs to be equated to the probability of loss and the impact, the consequences that loss will have in your financial life specifically. So the conversation about risk is more associated to your understanding on how to underwrite, how to assess the likelihood of success of an investment. Two people buying a home, one may be speculating, one may be investing. Your ability to understand the likelihood, the probability of success, and how to manage the terms, the variables that may affect that probability. Can you get a larger down payment? Can you have a tighter contract that allows you to take control of a property if people don't pay you back for a property you're selling or finance? All these things around investing are, again, and risk are about how much do you know, how much are you aware, and how much control can you exert to manage the likelihood of success in a particular allocation on an investment. So, very fascinating conversation. But we do this intentionally. So at least you can decide. Maybe you're not an expert on risk management on everything you own in your balance sheet yet, but at least you can say, hey, if my preference is to be conservative, ultra conservative, or ultra risky, I can take this decision and communicate it to my spouse, to my kids, to my business partners, to my CPA, so they can give me advice from that lens, that perspective.
Yeah,
So,
I think that's a great point, but I always say risk is just a measurement of the magnitude of failure, right?
mhm.
So if something fails, what's the worst possible case scenario, and can we live with that? That's
Can
the
we
ultimate
manage it?
measure of risk,
Yeah.
right?
Yeah.
And can we manage it? And so I think there's something to be said there, because a lot of people don't appreciate risk. I don't know that they don't understand the risk. They can feel it, but I don't know how you quantify it, right? It's like that old adage: If I had to walk across a plank between two buildings, I see it as being risky if I have no outcome, no purpose to go across the building. But if the building's on fire and I have to go get my family, I'm definitely going to go do that. And so I'll take that risk because of what it's going to do for me.
I'll give you the perfect, and obviously this is our world, but I'm going to give you a perfect analogy he uses as well, Mr. Marks. He says, okay, risk cannot be quantified before or after, but risk is something that must be managed, not avoided. And he talked about life insurance companies, which I thought is fascinating. He talks about he asked the question, why would life insurance be able to sell insurance to an event that is 100% probable happening? We all will die. How can life insurance sell insurance against an event that is 100% likely to happen? And he makes the point, it's because they're not avoiding the risk, they're managing. They are observing the risk, they can identify it, people will die. Therefore, they have mortality tables, they'll produce a medical exam, they will avoid adverse selection with people that perhaps may have a particular disease or a particular age they're not insurable for. They're, by the way, diversifying risk. They're not picking just males at 50 on a particular condition. They have young and old, they have female and male, they have different geographical locations, right? Managing risk is a deeper conversation. And when it comes to the you and me level of the things we own in our balance sheet, we need to understand again, we probably should be buying things we know and understand. And we probably need to be assembling a team that can help us give us guidance on how to do asset protection, tax protection, et cetera, to become risk managers of the investments in our portfolio.
Yeah, it'd be nice if we had a tool like that. Oh, we happen to have something that at least addresses that, right? With their well
Yeah.
scorecard. So
Yeah.
again, the well scorecard is another tool that David has and we have at our disposal, but that's a conversation for a different day.
Yeah.
So we talked about risk, and I think that's just really important to understand what risk we take with our investments. And we get really clear about that. Then we say, does that align with my values? Do I want to take that risk? And does that align with my values? If we get real clear about that, there's a lot of freedom in that we can find. It's, oh, I don't have to worry about that because I understand it now versus just blindly putting my money somewhere.
Yeah. And the ultimate expression here of this, how the whole workbook comes together, Wayne, is the conclusion of our seminar is, hey, now that we are very clear about what's happening in our income statement, how much we save, our debt strategy, and then we bring that down to our balance sheet, where are we going to store those savings? How much of it are we going to accumulate in our investments in general? The balance between these two things is what actually brings risk management to the equation. Our liquidity will act as a support system to protect against the risk we have at the top with our acceleration or our investments. And the ratios of these things at different points in our life, sometimes we may go press an investment because it's a great opportunity. We go all heavy on investments. And then sometimes we pull back and we have more liquidity because we may see an event coming our way. Management is the active word in financial management, and balancing these two things, identifying, hey, I want my portfolio to be 70-30, 70% investments, 30% liquidity, 80-20, 90-10, 50-50. No wrong or right answer. But the actionable part of this, knowledge has as a purpose, action, not knowledge, is that then I can go into my investments and say, maybe I need to liquidate this because I need to reposition it in a different investment, or I need to move it to my liquidity. And then when we go to our savings environment, say, okay, now that I have $50,000 in liquidity, I need to make it $250,000. Where am I going to store that liquidity and where is it coming from? Is the ultimate expression of that risk management, financial management, and how we bring tough money at all times as a habit, as a practice to manage our financial life.
Yeah. So I'm going to wrap this up, David, and I'll give you the last word. But I'll wrap it up. And I'll give you the last word. I like how that came out. I'll summarize how I think about it, and I'll give you the last word. Maybe that's a better way to say it. The idea of liquidity is our hedge against risk, and that's what we can use to manage our risk. And sometimes we need a lot of it, sometimes we don't need as much, or we're going to go all in, just with an understanding that's going to be there. So, again, I'll start at the beginning. We have to understand what our income is, where it's coming from, where it's flowing to. Where do we want to redirect it? Where do we want to store it? How many days of liquidity do we have to protect ourselves just in our lifestyle? And then that liquidity can serve a secondary purpose by offsetting risk in our investment side, because again, if that heads south, or if we're in a retirement distribution, we have retirement distribution plan says we need to take X amount of dollars out, the market goes down, whatever is happening,
then we have liquidity to make up that shortfall. And having that understanding of that balance and the ability to rebalance it because it's sitting someplace that's not correlated to the market is ultimately the key that's going to bring us the power and the leverage and the freedom and the certainty and security that we're looking for. Is that fair to
Yeah.
say?
It is exactly it. This tough money curriculum is truly a way for our business to bring to our community a framework to get closer to our money. We need practices, habits where we are closer to our money. Whether you are at a saving strategy level or you want to go and rebalance your portfolio and you're very sophisticated, whether you make $10 million a month or $100,000 a year, this is a conversation that will be simple and clear for you to have with your teenage kids, with your board of directors or your business partners, to bring closer relationships to your money, to have clarity, simplicity, to know what actions to take to move from where you are to a target location where you improve that health in your financial life by just thinking about the following. The ability to thrive through future events is a function of how tough your money is, how well prepared you are for those events, and how you continue to move forward and growing through events that you may control or may not control in the future.
Well said, David. Thank you so much for spending your hours with me to walk through this. I appreciate the conversation. I appreciate the impact we can have with people, because that's the ultimate. How can we positively impact people in their thought process and how they think, and really giving them the tools and the ability and empowering them to grow in this conversation and grow in this thought process. Because again, like you said, this education is a process. It's not an event. It is going to be lifelong. It's going to be continual. The more we do it, it's like anything else. It's going to be just as repetitive as breathing as we do it more and more. But we don't want to take it for granted either. I would just say, if this is something that you want to engage in a deeper conversation, we snorkel through a lot of these topics. We need to go deeper if it's for you. If you want to change kind of what's happening in your life, engage with David, engage with me, and say, how do I learn more about this? How do I take this and make it a bigger part of my life? And how do I educate my family or my business partners? I would love to bring this to my board of directors. David, would you be willing to come out or have a Zoom meeting with somebody to bring this conversation? I prefer one-on-ones, but sometimes that's not always the case. Or if we're in the neck of the woods, do you want to hear about this? Maybe you want to throw that plug out there a little bit.
Absolutely. We are making this a flexible curriculum because we are in the business of maximizing the impact that this education has. We are teaching this to brokerages across the country in a live stream we do once a month to hundreds of people. We are doing one-on-one conversations every week. We are doing different masterminds where we teach once a week a curriculum for 8 or 10 weeks. We do one day have events. We have 3-hour events. We have 1-hour presentations. So if you're interested in really bringing this community to your family, to your business, to your community, we will have the curriculum. By the way, this is all backed up by a course that is recorded, that we have digital workbooks and a whole infrastructure behind it. This is our professional way of bringing to you this education. So we will be able to support you. If you want to get in touch with us, feel free to email Wade or me directly, David Zapata at factumfinancial.com. You can find our team at factumfinancial.com, of course. But it's a curriculum, again, that we're distributing to corporations, individuals, many of our partners and their communities on a weekly basis, and we will be prepared to bring it to you at any point.
All right, well, thank you so much. I appreciate it. I just say for everybody that's listening, this is important to you, but also how important is it to everybody else that's around you? Is this a podcast that you would like to share? Give us a thumbs up, a positive review, whatever you can do to share this message, because this is the freedom people are looking for. This is the understanding and information that's going to be so valuable to people. And if you like it, and if you think there's something there, engage with us. We'd love to have a deeper conversation. So thank you so much for your time.
Thank you, Wade.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.